Now is the time for change. Doing business in the 21st century is made possible with Ngongi, external and internal audit assurance providers. Log on to ngongi.com to find out more.
In days gone by, companies actively plan to legally pay less tax. This was considered just good business practice. But since the Starbucks affair, where the company ended up making a £20 million donation to the UK tax office, companies seriously have to consider the impact of tax planning on their reputation. Our guests on the panel today are Pete Nell, Project Director of Tax at SACA, and Zweli Maboza, Head of Tax at SNG. I'm Leigh Roberts, and with me is Mervyn King. Let's start with Starbucks. I mean, it's such a remarkable story of how their previously loyal coffee-loving customers went on a boycott in the UK.
Absolutely. So this is a question of society. And it's very interesting that we were all brought up on a basis that the calculation of tax is a backroom exercise. And it was never a matter on the agenda of the board. But towards the end of the 20th century, we knew on analysis of the great stock exchanges that 80% of value was not made up of additives in a balance sheet according to US GAAP and IFRS in this part of the world. And avoidance schemes, perfectly legal, e.g. Starbucks. However, society sometimes does not accept that. You only had Starbucks coffee drinkers paying more tax individually than Starbucks was paying as a company. And they just rejected this. So the question is, the planning of taxation today has become an issue which the board has to consider as part of its strategic long-term planning for its business. Because you could enter into a perfectly legitimate avoidance scheme which could save the company 100 million rand in tax, but it could be a scheme which is rejected by society, which is a major stakeholder of your company, and as a result your 80% of value could drop and your market cap could lose 300 million on your market cap. So you've got to look at the impact of these things, and although it might be perfectly legitimate, an avoidance scheme could actually impact on that 80% of value.
Because really, in this case, Starbucks UK paid minimal amount of tax over 14 years of doing business in the UK. How do they manage that?
Well, they actually play around the fact that you've got two jurisdictions and they actually define a resident in different ways. That's the first point, because you would have an institution or an organization that would have an institution or one entity in Ireland or in a different country, and then you would have another institution in another country. But what then happens is that you find that in a process, one organization is not a resident in both countries. So when you do something like that, the taxing opportunities for both countries are lost. And in actual fact, sometimes you find that certain countries, they're not that much concerned about tax because their intention is to create jobs. So they are happy to have a lower tax, okay, like in Ireland. Although sometimes you realize that people, they don't even get those job opportunities, in particular if you're looking at other organizations that are hiring high-skilled people.
Peter, what's your comments on the whole Starbucks affair?
Well, basically on what they've done or how they've achieved the low tax rates. It's principally, I mean, it's easy to understand. You don't grow coffee in England. So you have to get the coffee from somewhere. And they used mainly transfer pricing, and as Zweli said, made use of countries that offered them. And in the Ireland case, in the Apple case or in the Google case, they were invited to actually come into the country in the late 80s to set up a structure there and said, we'll give you tax incentives. So they made use of perfectly legal incentives in other countries where initially your coffee was grown, and just have by way of manipulating, or not, manipulating is probably the right word, the transfer pricing, the price that they used from the supplier, and the profits were made in the low tax jurisdictions and not in England. So that's how they managed to, over a period of, as you say, 14 years, They legally were sitting with a tax loss at the time that this outcry arose. So there were no real need for them to pay taxes. And that's why I think you're apt by saying that they made a donation to the country there.
of an extraordinary £20 million. Just a huge amount. But the MD of Starbucks UK, Mervyn, he's quoted as saying that they made the payment because it was the right thing to do, and that doing the right thing did not only mean doing what was right by shareholders.
Well, this is the whole point, that you had actually the man in the street or the woman in the street actually boycotting Starbucks coffee shops. So from a practical point of view, something had to be done, and hence the donation. And is it the right thing to do? Well, that's interesting, because your pension fund might well be holding shares in Starbucks.
Yeah.
And you could have a reduction in share value, and you could have a reduction in dividends, one way or the other. But the question of ethical taxation, society not accepting the behavior as a result of transfer pricing, so that in the UK they were paying no tax, and they were moving the profit to a jurisdiction where they had to pay less tax. So this was unacceptable to society in the UK. So it was seen as the right thing to do, to make a donation to Her Majesty's Fiscus. But the right thing for whom? You know, it can be seen from different sides.
It is a really complex debate.
It's a societal thing.
Yeah, because at the end of the day, you're dealing with humans. But I want to go on to the other famous case, and that was Google. Now that chairman, they decided not to make a donation to Her Majesty's Revenue Service. Chairman saying that they had done nothing wrong. It was the way the international tax system worked. Pete.
You see, I think this is where the ethical decision comes in. When we look at tax, we say it's legislative. So you look at the words, and the question that the company grapples with is, do I follow the letter of the law or the spirit of the law? And then making my decision. So looking at them, they're happy that they follow the letter of the law. They don't owe the government any taxes. So they're not going to make a voluntary payment to do that. They're making use of legitimate means of reducing their tax bill, and that's where they will stand.
But when does tax planning when does it become deeply aggressive?
Well, it becomes aggressive with hindsight, because everybody is...
when somebody complains.
When someone is complaining. I mean, if you take the example of Starbucks, it actually took the consumers to actually say, we are going to actually be heard by Starbucks, and we're going to hit it where it hurts most for them to start listening. Because what is happening is that with the legislation, as Pete pointed out, you find that sometimes even the tax authorities, they stick to the letter of the law, and they don't even look at what is the intention of the legislation. And then sometimes that may favor the taxpayer. Sometimes it can work against the taxpayer. Now, I think that what needs to happen is that in the process of revamping the tax legislation, which is what seems to be happening now with things like transfer pricing, that is something that needs to be built into the whole legislation drafting, to say, if you talk about the spirit of the law, it has to work both ways. Because what then happens is that if I know that tax authorities are looking at the letter of the law, they must not complain if someone is doing exactly the same thing and they are getting the advantage of that. For example, I mean, these countries, they've got double taxation agreements. The question is, how can you have something like this when you've got brains from one country, brains from another country? They're drafting the legislation, and they come with loopholes like this.
But that was the problem here, because these are multinational companies. They're also internet-based companies. So who fixes the whole internet and double taxation agreement problem?
I mean, I think that is the dilemma. Yeah, we've had in the Starbucks case, your public at large coming out and say, we feel you're unfairly paying that. But I think generally the feeling is that you need government to legislate. So as we say, we play within the ambit of the law. And let's say we actually go further than just a letter of it, and we say this is the intent. So we're not giving the government more than we should, but we're giving them their fair share. Now, you don't want the company to make that call. You need the law, so you need the rules, so that we have that. Currently, governments are exchanging and entering into agreements to exchange information, because the moment you are worldwide, and I mean you talk at your business happens in the cloud here basically. Where is the source of it? And those are the parameters that people play around with or plan around with. You've got different, like I said, the coffee is in one country, you've got to play with different countries of residence, places where you effectively manage your business, and then you've got this transfer pricing issue to get your profits from one country to the other.
So, and Mervyn, so even though there is a disparity in tax jurisdictions around the world, I guess it comes back to ethics of the company involved.
Well, I know this phrase has been developed over the last couple of years, ethical taxation. But my view is it's a business judgment call by the board, because there's greater expectations from stakeholders than ever before out there. And the question is, will the company be seen to be a decent corporate citizen? And if the company is not seen as a decent corporate citizen, there's an adverse reaction from society at large, what I call this tapestry of individuals, that makes up society. And if so, it impacts on your market cap. So the question of legislation is something so complicated, because in the nature of things, the government can legislate and it's bound by geographical borders. So it's very difficult for 110 countries together and pass one law, because it's just not going to happen. So you might try and fix it with double taxation agreements. That's also complicated. So it's a question, I think it's a business judgment call. It's not an ethical decision. And people have labeled this ethical taxation, but the reality is that society is reacting to a company that's not paying its fair share, or they don't see it's paying its fair share. So you as a director now have got to make up your mind. Do I enter into this avoidance scheme and save the company 100 million in tax? But what is going to be the impact on my market cap of my company?
Yeah.
And
So
if it's going to be more, then you shouldn't do it.
But do tax consultants think of the capitals other than financial?
No, well, I mean, if your brief would be really, I mean, if your client comes to you and says, look, this is the structure, this is where I have to operate, you will come up with the most tax efficient way to do that. Yeah. And I think it's isn't it, maybe Mervyn, you can comment on that, isn't it that the companies don't actually communicate the tax policy? We've now seen some of the bigger companies incorporating that. So it was a matter that nobody knew that you had this complex structure, and that you actually had to route it through different countries to end up in England. So if you explain your tax policy, then people know where you stand, and it's only when I think the ethical point comes in. So somehow I feel that there is some ethics involved, is when you go over to the aggressive one. So you've got a way that's perfectly legitimate, making use of the legislation that's available, but the moment you cross that border now aggressively, like really saying, go into a tax scheme to really exploit it to the maximum, that in my view may be an ethical point.
So tax consultants aren't really to blame on that point. Stay with us, we're going to a short break now. There's more on ethical taxation when we come back.
Ngonki has the professional capacity to deliver on your external and internal audit assurance requirements. Visit ngonki.com